Today we are covering the state and local tax deduction, commonly known as the SALT deduction, and its all-important limitation. The exam will test your understanding of the $10,000 cap per household, which drops to $5,000 for those with a married filing separately status. This cap combines three specific types of state and local taxes. These are income taxes, real property taxes, and personal property taxes. A classic exam question will give you a scenario where a taxpayer has paid amounts for all three and ask for the total deductible amount. For instance, a married couple filing jointly paid $12,000 in state income taxes and $9,000 in real property taxes. Although their total SALT payments are $21,000, their deduction is limited to $10,000. The exam loves to trip you up with this hard ceiling. Another common trap is the choice between deducting state income taxes or state sales taxes. You can only choose one. A question might list a taxpayer's state income tax paid and also provide enough detail to calculate their state sales tax deduction. You must remember to pick the larger of the two and then apply that amount toward the $10,000 limit along with other property taxes. You cannot deduct both. Be extremely careful about the character of the property tax. The $10,000 cap only applies to state and local taxes on non-business property, meaning your primary residence or a vacation home. If a question mentions property taxes paid on a rental property, that is a business expense deducted on Schedule E. It is not subject to the SALT cap and does not count towards the $10,000 limit. The exam will try to confuse you by lumping them together. For example, a taxpayer has a $10,000 personal property tax bill on their home and a $4,000 property tax bill on a rental duplex they own. The $10,000 is subject to the cap on Schedule A, but the $4,000 is fully deductible on Schedule E. A key mnemonic to remember the three components is RIP to the full deduction. Just remember R for real property taxes, I for income or sales taxes, and P for personal property taxes. The exam might also touch on state workarounds, specifically the pass-through entity tax or PTET. Some states allow partnerships or S corporations to elect to pay state income tax at the entity level. This tax is then deducted by the entity as a business expense, and the owners receive a credit or exclusion on their state return. The key exam takeaway is that this payment becomes an above-the-line business deduction for the entity, effectively bypassing the individual owner's $10,000 personal SALT deduction limit on Schedule A. The question won't ask you to calculate a state-specific PTET, but it will test the concept that this shifts the deduction from a personal itemized deduction to a business expense, thus avoiding the cap. Always check the filing status, as a married filing separately taxpayer is only entitled to a $5,000 deduction, a detail that is easy to miss in a long fact pattern.